Hello, hello. Welcome to Fridays in Fintech. I'm Jake Pimentel, co-founder and CEO of Tennis Finance, and we have some wonderful, wonderful guests joining us from all over the globe. And today on this podcast episode, we're going to talk about some interesting trends, maybe in AI, as well as ethics with working with AI, and kind of fintech in general. Like where are things going? And really excited to hear from them. And I'd love to give a great introduction about these folks as well. So first off, we have Rick Bachman. He is a founder and managing member of Scale Consulting. He has been instrumental in helping over 200 fintech startups. Rick, that's super impressive. And then also had, yeah, yeah, it's huge. And also spent time at Lending Home and Wells Fargo. Next up, we have Simon Taylor, currently leading is head of strategy and content at Sardine. Also co-founded a 11FS, and also really interesting fact, founder of Fintech Brain Food, which is a great newsletter with over 37,000 subscribers. And after that, we have Gene Yoshida, someone who is very involved with fintech and venture capital. He has been mentoring startups at Berkeley Skydeck, as well as provide strategic advice to fintechs like Karat Financial and compliance.ai. Also, advisor to Yaka Ventures, Hard Yaka Ventures. And last but not least, we have Jonathan Joshua, a veteran finance attorney has great expertise in fintech, financial services, also the principal of Joshua Law Firm as well. He previously spent roles at Mannett, Phillips and Phillips, also a VP and senior counsel at Citizens Bank, and has a ton of knowledge on regulatory and legal challenges in the fintech space. So, welcome, guys. How's everything going?
Thank you
Thanks for having us.
Happy Friday.
Thanks for having us.
Happy
Yeah.
Friday.
Yeah. So first off, what I like to do, I really like to ask the hard-hitting questions in fintech, since you guys are all experts. But really, yeah. So do you guys prefer pineapple on your pizza? This will help me actually judge kind of how you guys work in fintech.
Pineapple on pizza is outrageous. How dare you? That is frankly shocking that you would bring that into this fintech conversation and you do that. Pineapple is the world's most attention-seeking fruit. Look at its silly haircut. It needs to go away. Get off my pizza.
I hate to disagree so early in the conversation. Everything belongs on pizza. It's anything you want. Anything goes.
Breakfast cereal?
Oh yeah. If that's what you want on it, make it your own.
Wow.
Well,
Strong decisions out the gate.
yeah, I haven't actually tried it, but I had a long conversation with my 5-year-old son yesterday about how many pineapples it would take to float a car.
Huh. All right.
Oh my God.
Yeah.
That's an interesting math problem to figure out. Maybe we'll have that answered by the end of the call today.
So, Gene, any thoughts on that?
I love pineapple on pizza. That's my go-to. Simon shaking his head.
The last thing
I'm
I'll say on
outraged. I
that.
thought we were cool, but you go and do this. It's not good.
It's funny. The last thing I'll say on that is the perfect blend, right, of sweet, salty, savory, right? And that's my opinion, but hey, who knows, right?
You know
If you like,
what?
you know what you know. You like what you like.
Well, I guess you won't be seeing
Fried
Simon on
pineapple,
another one
my
of these.
He's like, I'm not coming back to that podcast. Well, great. Well, I'd love to kind of get into it and really ask, like, Simon. I mean, I've talked to so many people. They love your newsletter. You probably cover the most fintechs out of anyone I know. It's really incredible. Like you have this wealth of knowledge, and really kind of what I was interested in is what new business models are you seeing in fintechs and the ecosystem, and where do you see new financial products gaining traction? I know there's been a lot of fluff lately, but kind of where are you seeing those trends?
So it's kind of weird that it's very rare and there's a genuinely novel financial product. Most things are slightly different forms of distributing the storage of value, aka deposits, the movement of value, aka payments, the time value of money, aka lending, receiving money or investing money. Like, you can fit just about everything into those buckets. What changes is who the actors are, the time involved, the compliance involved. It's kind of the features around the balance sheet stuff that tends to change a lot more rapidly. Like, the collateralized debt obligation is probably one of the last genuinely novel products I can think of. Sort of like litigation litigation defense as an asset class, as an investable asset. That's kind of new. But really, a lot of what you saw, even in the wacky world of DeFi, is products that have always existed with just a wildly different distribution mechanism. So, like, at the core primitive level, there's not a lot new, but at the business model level, definitely seeing a couple of big pictures. One, fintech dramatically reduced the cost of acquisition and the cost to serve with modern technology and different distribution. Obvious example, neobank cost of acquisition is 10x less than one of the big five bank, and a neobank cost to serve is at least 10x less. And the next battleground will be keeping that low cost and driving deeper revenues. And so I think the next generation of companies will be 10x cheaper again in terms of their cost to serve and their cost to acquire. So that's like cost battleground on the simpler products. The newer products that fintech is attacking, though, is further up the complexity stack. So think about things that we weren't talking about 2 years ago. We weren't talking about private credit being distributed to consumers or APIs for private credit. And the old model of private credit was, this is too complex, it's too fragmented. We weren't talking about a Series A startup doing deposit sweeps, but that now exists. So we've kind of gone up the complexity stack. So I don't know if these are necessarily new business models, but it's certainly disrupting traditional business models and going two different ways. So we're coming up the complexity stack, and we're reevaluating the cost model every decade or so. That's a starter for 10.
Wow, super great. Anyone else to add anything to that?
I'm happy to chime in. I agree with that, but I think that part of the reason why there's perhaps not much in the way of new models from a product standpoint, maybe regulatory. I've been involved in things like income share agreements, home equity investments, and other products that are either very similar or very different depending on who you ask, and is often driven by, or at least to some extent, by regulatory treatment. And but I mean, to your point, obviously it's who gets how much when, no doubt. But there were certainly differences with some of those products, and the hard part in large degree was the regulatory piece.
Yeah, I think that's an interesting thing. I've seen that several times as well, where when they've gone out to have an interesting product that people haven't seen yet, the regulators haven't been ready for it, and so there might not be regulation around that product. So or marginally. So equity sharing or equity investments, options contracts, things like that. There's several companies that have done that. They've done it pretty well, but the regulators really didn't know what to do. And so either you get ahead of it and you try to talk to the regulators and say, here's the product we're interested in doing. Can we do it? And they say, well, we don't really know. We've never seen that before. Or you wait for them to come to you and say, hey, you're covered by this law, that, and then you have to battle it out after the fact and say, well, no, it's not. This isn't a loan. It's not debt. You need to think about it differently. So I think, sometimes it's within the framework of the existing regulation that you're offering all the products, the deposits, the payments, the credit, and other times to be and do something interesting. It's outside of what really has been contemplated by the regulation so far anyway.
Very interesting. Yeah, I think it's really
if I may, Jake. Sorry,
Yeah.
I hate to be that guy, but what's really interesting about those comments and what I reflected when I heard them was specifically around I can't remember what was the example Jonathan
Home
gave.
equity and
Equity,
income
yeah,
sharing.
right. And Rick, I think you spoke about options contracts, right? These things existed. They were specialist products that would exist, like a wealth manager or a private bank would get you access to them. They weren't available mass market to consumers. And what digital did is it reduced the cost of distributing these complex things. And when you make these complex things available without friction, you have a whole bunch of consequences that the regulation wasn't designed to capture. And we see the same in banking as a service and embedded finance, right? Like the regulation was built for a reality that is no longer true because the distribution changed and the customer changed.
Yeah, I think in the US in particular, we definitely had different elements within the regulatory frameworks that help with the regulation keeping up with technology. Things like a sandbox environment where it was open grounds to test, also non-objection letters. And then, I think one of the innovative things that the CFPB did early on was something called Project Catalyst, where they dispatched people to do a lot of outreach across fintech to understand what are the emerging technologies, what are the risks associated with them, and could it actually become something more systemic that could impact the financial system, and actually working with technology companies to understand how do we regulate these things, how do we control for them, how do we make sure that we're maintaining safety and soundness within the banking system. I feel like we need more of that, particularly in the US. Looking at crypto as an example, what's happened there. Had we had more of that, I think we could have navigated through the advent of crypto and other types of technologies a lot better.
Oh man, I want to talk about crypto so bad. Very, very interesting. I think, doubling down, right? More complex models. How does that work? How do we actually get the regulation in front of that, right? And all these newer types of business models, there's just the regulations weren't written for that, right? So it'll be interesting to see what happens going forward. It's very exciting. And so, Rick, you've been advising tons and tons of startups. I can't believe it's like close to 200. That's insane.
Yeah.
So really, with these new business models, these new fintechs, I mean, what are you seeing? But there is regulatory challenge, but what are some of like the strongest challenges that they're facing right now as they grow early and late, right?
Yeah.
What are you kind of seeing in the market?
I think there's a few things that are the biggest challenge, right? And all of them, you're kind of looking at a stool, and if you take one of the legs away, it doesn't work, and so you've got to think equally about them. Simon mentioned the products themselves, and is it an interesting product that people want, and is it different than what somebody else offers? And I think when I first started Scale, a lot of it was just a regular a debit card program, or prepaid actually, and then into debit programs. And there really wasn't a whole lot of differentiation between a lot of them, but there was a huge market, and so there's still a lot of people needing those, and there still are, and I think there's still lots of opportunity there. But it started that everybody was doing that, and then they said, well, we need to have some value add. What if we planted trees, or we did something green? What if we did carbon neutrality, something like that along the way? And so they added that as a rewards program, or somehow tied it to their card. And then, got further into that, and then crypto took off and said, wait, let's add a crypto element to this. We don't care about the environment anymore. Let's go crypto, add crypto rewards. This is going to be great. Crypto winter hits. We regret that decision. What do we do now? And I think that's been kind of an interesting change. So what after that has happened? And what I've seen a lot is more into that lending space, realizing that maybe there is some saturation in the debit programs. Let's add some lending products, or maybe we've got a big share of the debit programs now, of the debit customers. Let's give them additional products. So that's one, is just the product set, and is what's being offered interesting enough. Two, and similar to that, I think, is really understanding the market and where your customers are coming from. As I've looked at so many of these now, where we'll model out and we'll try to see what the revenue is going to look like. Does it make sense? And how are we going to deliver this card? Are we going to use a BaaS provider? Are we going to go directly with a bank? All of the models rely on a certain number of customers. And I think sometimes there's not enough thought given on where those customers are going to come from. To say we're going to have 1 million customers by the end of next year. Well, whose customers are you taking that will come over to yours, and why will they come to your program, and what's different, and what are you offering? Sometimes it's the way that you communicate with those customers, and that's enough. That we want somebody who gets us in whatever our community is, and we'll go to whoever talks to us in the way that we want to be spoken to. Other times it's features of the product itself, or rewards, or whatever else. So 2 is customers. 3, obviously compliance. And seeing that shift from the early days of sponsoring programs and the compliance and the due diligence that happened early on compared to where it is now. All of the banks have put the pressure, or the regulators have put the pressure on the banks, who then put it on to the new programs and say, you can't just come in with some chat GPT policy documents that say, here's our BSA policy. You really need to understand it. You really need to be able to apply it to the business and it be meaningful. The words from the regulation, if you're literate, you can put together a BSA policy, but it doesn't mean it works for you, and it doesn't mean it represents how you do what you're supposed to be doing. And then 4th, of course, is funding. And just seeing the shift in there. All of those first 3 combine then to be the funding issue. You're not going to get the money unless you have a good product, you have a good idea where your customers are coming from, you know how the governance pieces are supposed to work, and you've got a good idea of how you're going to communicate this with the banks, and sometimes even directly with the regulators, to get them comfortable with how you're planning to do this. So there's plenty of challenges, and I think there's probably more, but if I think of a 4-legged stool, those are the 4 legs, and any one of those that doesn't work right, the program just won't be successful.
Anyone got any other thoughts on challenges that you're seeing in the space, especially with fintechs early or late?
I think the big one is nobody gets into, especially early stage fintech, to manage compliance. It's usually some other motivation, right? It's like, I'm going to go solve a problem for consumers. I'm going to solve a problem for my customers. I'm building with positive subjective intent. And the rite of passage that almost every company goes through is, when you are a small company, the money mules just start appearing. The fraudsters just start appearing because they go for the weakest link in the system, and guess what? That's you, and you're it. But now you are a massive liability for your partner bank, and you're going to get offboarded. And a partner bank who had a second line support team of 1 person might have 10 programs that suddenly have exploded in volume and done really well because they had a ton of marketing budget. And so this 1 person is trying to use spreadsheets to keep up with 10 programs that are getting tens of thousands, maybe even hundreds of thousands of customers really, really quickly, but not necessarily with the depth of understanding of what those policies really mean. To Rick's exact point, I can understand it, I can have it on my website, but it doesn't mean I get what that means when the attack comes, and what SARs need to get raised, and what case management looks like, and what investigations look like, and how on the hook I'm potentially putting my banking partner. Like, it really does put the capital P into partnerships, the level of responsibility that a program has on behalf of its partner or its sponsor bank. So I think that's such a crucial point that people don't understand. One of the things, obviously the regulatory response is one thing, and there's probably a bell curve distribution of different partner banks and their ability to help fintech programs go from 0 to 1 in this space. But it's something that is an expectation of regulators, We are speed running having to get that into place. But, partner banks, especially, they tend to be skew a little bit smaller. They can't necessarily hire 10 new staff for every 10 new programs they bring on board. So, what are they going to do? Like, how are they going to be in this game? Should they just exit it? I think it's an incredibly hard space to be in, and I'm not surprised to see some of these dynamics starting to creak and break.
Yeah, I think that bank piece is so interesting too. I think there's a lot of smaller banks who felt like they've missed out on the bulk of what's existed out there. So they try to jump in. And that's even scarier sometimes of we have nobody to support this. And I've worked with a few banks too to help them put together their programs on how they even start thinking about this and what does the due diligence on their side, what should that look like? And what do they need to do to staff to support this ongoing? and not just miss out, but like not jump into something that they have absolutely no business being in, and completely ill prepared to even try. But there still is. I mean, there's still I see every day a bunch of new programs coming out. So there's still an appetite on both sides, but the how you do this is increasingly important.
I'm seeing a lot of a huge renaissance as well of RegTech companies that are coming up, including Tennis Finance. Jake, little plug for you there. That are helping
Let's
support,
go.
provide technology for this problem because Rick and Simon, you're absolutely correct. A lot of the best banks are smaller banks with smaller compliance and risk teams, and therefore, how do they bridge the gap in meeting these compliance obligations and risk obligations, particularly in an environment with heightened regulatory scrutiny? I think the way to bridge that gap is through technology, whether it's through Tennis Finance and an application of AI, or a GRC tool like Themis, where it actually facilitates communication between between the bank as well as the fintechs and managing the programs. And so I see that as a trend that's going to continue within the RegTech industry, but also banks leveraging that technology.
I found it so interesting that in the three agency guidance, the three federal regulators, there was a lot of a nod to, hey, it's okay, banks, for you to use modern technology companies to help you solve this problem. It was almost like, go use automation, please. Go use RegTech, which I did not expect to see from regulators. And that's probably something that got lost on a lot of the heads of compliance and chief risk officers in the financial institutions, that, hey, there's another type of partner here that's called RegTech. Themis, Cable, you mentioned, it's what we do at Sardine. I know Unit 21 and Alloy do a lot. Like, go look at these things. Go look at Tennis Finance. Go see what you can find.
Having been a big bank lawyer in a prior life, it's not always lost, but I think sometimes the big banks or the people who've been around for a while can sometimes take statements like that with a grain of salt. And a regulator may say it is great to use technology, but any technology that you actually try to use may still be a problem. So I mean, I'm absolutely, I definitely think that they were trying to encourage that, but at the same time, that was not meant to be a license to do anything that you otherwise can't do.
Yes, when you're having third and fourth party guidance, you're potentially adding new third and fourth parties.
Right.
It's
Well,
Russian dolls of complexity.
But with respect to the technology piece as well, like, yes, everybody should use technology, and another plug for Tennis Finance. But if you can't demonstrate that you've truly thought through all of the potential ways that it could go wrong and you've mitigated it, then you've added risk rather than preventing it. And that the thing about a new technology is that you may think you have a good handle on it, but that doesn't mean a regulator isn't going to come in after the fact and say, well, this risk, that happened was obvious beforehand, and you should have thought about it, and your controls were weak.
The
Yeah,
obvious in hindsight thing is the hardest thing about dealing with regulators. I remember the first time I ever met a regulator. They described their their job to me in a sort of sidebar conversation. I was very, very early in my career, and I said, "What? How would you describe your job?" I like asking dumb questions, and they said, "My job is to get people to demonstrate that they've been thoughtful about risk." And I thought that was such a great way to summarize it. Like, yes, show me you have been thoughtful about the risks before you've dived in with both feet.
Mm-hmm.
You know,
So,
interesting on the technology side, having seen a number of these now, and when we're having conversations maybe between the bank and their regulator on how they're going to start sponsoring a program, and you know, going through the non-objection process and that type of thing, and when we start talking about technology, it's always interesting. You know, all of us are familiar with Sardine and Alloy and Unit 21 and this and that list of 10 or 15 that everybody knows. So it's always fun when you get into that conversation. They're like, well, now who is that? And you kind of start from scratch and like, okay, well, here's what they do and how they plug in, and it's API driven and this and starting from scratch each time. Uh, Even though you think that by now the regulators are fully aware of this, they've seen it hundreds of times, thousands of times. But depending on who you're talking to there, and sometimes it's a branch office even of an OCC, and their person in their branch has never heard of any of these things. And so at least it's a nice kind of grounding moment sometimes too, to say, let me take stock of what this environment looks like and how do I explain it in a way, and can I feel comfortable that when I'm talking about this, it's not just words, it's not just, oh, there's somebody who does this, but I understand what value they bring, how they do it, how it works, what risk it mitigates, and can I articulate that the right way to the bank, to the regulator, and to the program itself.
Funny, I wrote a slide in 2011 describing what an API was for an issuer processor in payments on the back of them discovering Stripe. And I have used that slide more and more often as time has gone by. You'd think it was known, but no. Like, there are so many people still starting from zero, and the smaller the bank or the newer the regulator, like, it's new to a lot of people. There was an old saying that a PR person to Tony Blair, the former Prime Minister, used to say, which was, by the time you're really bored of saying something, it's just starting to land. And I think from a RegTech standpoint, we're not even getting bored yet. Like, we have to say the same thing over and over for this message to start landing.
and I think what's interesting is by the time anybody gets comfortable with it on the regulatory side, probably will have moved on to something else. I was
Oh,
go ahead.
Go ahead, Josh.
No, I was just thinking about the CFPB's open banking proposals, adoption of APIs, and how that's great for 20 years. And then what? Then people will have to use APIs, even if they don't want to.
No, absolutely. And I think for the banking industry in particular, the approach around APIs has been particularly challenging because we're on, kind of old school cores that with many of which it's very difficult to have an API endpoint too. And so then you have the rise of middleware providers that help bridge that gap. But I think this is really important for the BaaS banking industry in particular, because one emerging trend that I'm starting to see is more BaaS banks bringing this data and this functionality into the bank itself and reselling it to the fintechs, particularly in the case of AML. So reselling KYC services or reselling transaction monitoring services, and really owning the subledger, which is the subledger to an FBO account, where the core banking system will store the overall balance of the FBO account. But sometimes they're able to delegate the recording of the subledger to the fintech, and they don't have access to that. Well, if you don't have access to that, then how are you supposed to directly monitor those transactions? You then are dependent on the fintech to fulfill a lot of AML obligations for which the bank is on the hook for. And as we've seen in the recent consent orders, especially the ones that have stacked up last year in 2023, many of them, I would say the vast majority of them, have some form of AML enforcement action embedded in those consent orders. And so if I were a BaaS bank, I would look seriously at how do I bring that subledger into the fold, into the banking system, and then being able to directly perform transaction monitoring as well as other AML monitoring on that data.
One of the advantages of doing that is you get to bake your risk appetite into whatever the program can and cannot do, and you get all of the reporting and all of the data from an oversight perspective on how timely are these SARs, what's the recall rate on fraud, what's the precision looking like. You can start to run all of the analysis that you would do if you were looking at your own ledger, and bake in that sort of oversight and control. It's one of the things that Sardine's done with Stearns Bank and Bangor Savings and many others, is that reseller agreement where they take our product to the fintech company. Yes, it's a source of revenue for them, but more than anything, it's a source of risk management, because now they've got the dashboard that you dream about, which is, here's real-time data on how all of my programs are behaving, and now I can set a rule once and it applies to all of my programs, and I'm going to get an alert from all of my programs. But this one's actually really good at managing that one thing, so I'm going to let them have a little bit more rope. Like, that control, I think, is going to be really important, because to your point, Gene, yeah, I'm yet to see a consent order that doesn't have BSA AML in there at some point. Like, it's always the one that catches. There'll be a bunch of other things, but that one's kind of consistent, isn't it?
I would suggest that may also be because it's a lot easier to point to. If you're not happy with a bank partnership, there's always going to be something here that you can point to. And if you can't articulate as well, or if your legal theory is less strong in other areas, you can toss that in as well.
Well, there's always the money laundering you didn't catch. And there's always a bit of a process issue, because we measure people on their process, and nobody's got the perfect process. And
Exactly.
what does perfect look like? And what does effectiveness look like? And how are you managing effect? That's a whole rabbit hole.
Yeah, no, I've seen, $100 million consent orders over, 5, mistakes or whatever, not in the AML space, but, if there's if the regulator needs something definite to force a settlement, that's a good one.
Simon, I think one of the things that you mentioned that is really interesting is, Sardine and Cable, these companies are really looking at doing near real time or near real time controls monitoring and testing. And you can do that once you have the data, right? Because it's just a matter of applying certain rules to it. But I think once the banks adopt this more broadly, I think the next step is to push it even further upwards to the regulators. Imagine having, rather than quarterly or, periodic exams, having the regulators themselves plugging into these systems and having a real-time view of where controls are failing, or where things are maybe going past a bank's risk appetite. And I think something like this can give a lot of confidence to the regulators around the BaaS space. And overall, we know that there's heightened scrutiny. We know that there's large concerns across the bank regulators. But I think the more visibility and transparency they have into what's actually going on and the actual data behind it, and almost on a real-time basis, the more confidence that they'll have in the system, and the better that they can oversee and supervise these banks and fintechs.
Of course, it only works if you're doing it right.
Yeah.
That's
what it should look like. I mean, when you were talking, Gene, the phrase that came into my mind was, all reg tech is supervisory tech. It's the same data that we're looking at. It's just somebody else receiving it with a different set of requirements around how that's packaged. And so, it's a data privacy problem, and it's a commercial confidentiality problem. And I think there'd be a lot of banks that don't want full transparency, and that shouldn't necessarily be the case. But there is some level of MI or dashboarding that would save everybody involved, frankly, an awful lot of time and energy.
I'll just add to that I've actually been having conversations with some of the AI reg tech companies about what it looks like when it's not just the financial institutions that have AI reg tech, but it's the regulators with AI reg tech. And it's the same idea, like it's the same product, but just like tennis finance can help find problems with advertising for a financial institution, it can do that for a regulator.
Yeah, that actually, Jonathan, that actually leads me into my next question, right? I think right now what we're seeing, right, is the bar is being raised. Like better technologies are coming out, and so how are regulators looking at this new technology? You know, LLMs, AI, better scraping, and actually implementing it, right? Is it going to be kind of this battle between fintechs and regulators, and then the bar will just be super high? I'm curious, how do you think what's going to happen in the future there?
Yeah, well, not no pressure on predicting the future. It's I think first of all, we've got an election in a year, and I think that will make an enormous difference, not just after the election, but in the period leading up to the election. I think that folks may be more willing to bet on outcomes of the election, or at least rely on the perception that certain outcomes may be better for their businesses than others. And I think that follows through to some extent with what the CFPB is doing and what the other regulators are doing and what they're planning. So I mean, we've got like the present and what they're trying to accomplish before the election, and we've got what happens after that. I mean, to a large extent, I think they're trying to cement in certain gains now, and on the off chance or with the concern that the next administration might not agree with it. And we saw it, 2 administrations ago to the Trump administration, where, like with the payday rule, the CFPB basically just said, no, we disagree with the old ability to pay requirements. And actually, there's a fun little item in one of the CFPB's recent rulemakings in which they basically disagree with the prior CFPB's disagreement with the prior administration's interpretation of the word abusive. And nobody's willing to admit that they've changed anything, but they're redefining abusive yet again. So from an enforcement standpoint, and without really prognosticating about the election, and as it relates to, I guess, innovation, certainly the current CFPB has been pretty vocal about innovation is great, except it doesn't give you any excuse to do anything other than what the law says you can do, which I think everybody already knew. But I think there have been folks who were willing to get a little closer to the line with respect to, well, this law doesn't apply, or this definition doesn't apply. And there hasn't been a lot of willingness to accept those arguments, notwithstanding the potential impact to an otherwise favorable, idea or model. I think the regulators have basically been said, this is what the law says. We're not going to give you any wiggle room, and if your product doesn't work, that's too bad. And so, I mean, I think we'll see how the politics plays out, whether that continues or not. But I think that in general, the consumer advocacy groups from which the current administration has drawn a lot of their personnel are deeply suspicious of innovation, primarily because they think the innovation is ultimately designed to get money out of people who can't afford it. And I think there is both some truth to that, in the sense of, yes, almost every startup's plan is to make money. And very often that comes from the consumer, one way or the other. But that it would be it might be worth pondering, where else, the money could come from, or whether or not having a service at all is better than not having that service. And I'm not sure that we've been seeing enough, or at least from my perspective, enough thought about, like, is this a net gain for everyone, even if, yes, some consumers will do less well under it. And, the decision whether or not to proceed with a policy that will hurt some people but benefit others, I think, is a tough one. And I guess I'm glad I don't have to make it, but I'm not sure I would make the same decisions that the CFPB is making. So I didn't quite answer the question, but I hope it was closely enough related.
Yeah, and I think for LLMs and AI in particular, that area of innovation, the FFIC has released an RFI on it and raised certain factors of risk like explainability, overfitting a curve, and data training, as and other types of risks like that. And I think actually it really comes down to model risk management. When I look at the list of risks that the FFIC has raised as part of their RFI, a lot of them can be solved with the existing regulation on SR 11-7 on model risk management, where you're to do a model validation to make sure you're looking at out-of-time validations or a holdout set and solve for a lot of these different things. One area of the regulation I think that probably needs to be updated for AI is looking at unsupervised learning, or more to the point where models are learning off of other models and they're basically creating new models for themselves, because I think the current model risk management practices are fairly static in terms of you develop a model, you see how it works, you monitor it over time, you update the model, and then you go through another model validation. And the reality is with AI, the model development techniques have become so sophisticated that models can actually update themselves. And so how do you then update the model risk management guidance to be able to control for that as well?
Gene, that's such a good point. I think Rick talked earlier about LLMs that sort of have literate policies, but that don't make sense for you and your business. There's that echo of sensibleness in almost every well-trained model, because it's been trained on enough data, it's going to get something that looks vaguely about right because it just has enough data. But is it actually right? And sort of that continuing data engineering is the grunt work that doesn't get the attention in lots of organizations. All data science is really data engineering, and all data engineering is really data governance. And it all starts and ends with that. And getting that governance in place is a discipline that, sort of when you want to buy that shiny new AI thing, every executive wants to get excited by it. Nobody wants to do the basics right. It's kind of like, people walk into the gym and want the beach body, so they go load up the rack full of heavy weights and do their knee in straight away. Like they hurt the hip and their back, rather than getting the basics right, which is you need to stretch off, you need to be getting these basic movements, no ego lifting, right? This is the get the basics right side of AI, is something that applies to anybody who's doing it day in, day out. And that is there in the existing regulation to the point that I think you're making, Gene. You've got to be able to explain this stuff. You've got to be running processes over it. But how many people have internalized what that really means? And how many people are just producing like a 20-page document that explains how their model works, except it doesn't actually explain how their model works. It just checks a lot of boxes. I think that's always like the hardest thing to get to the bottom of.
And going back to your earlier point, Sai, about having real-time dashboards, it becomes even more important when you're probably updating your model continuously, to also update your outcomes dashboards continuously.
Completely. OLAP versus OLTP is the classic combination, right? So there's the model that you initially train with, and then there's the model in production, because one is built for transaction processing, it's built for speed, and the other one is built for analytics. These are two fundamentally different types of kind of software and what they build. And nearly every company has at least one giant data bug hiding in plain sight because of the lack of discipline in syncing the training data with the production data. And syncing that on an ongoing basis is something that very few have thought through from first principles because they don't have data science backgrounds. And that, if you are relying on it to make decisions about your BSA AML policy and or other major decisions that could impact your position with regulators, sounds trivial. It's like, oh, it's a weird little data science thing. It's critical to your effectiveness and your ability to know what is effective and what is not.
I'll add in the fair lending piece to that. Yes, absolutely.
Another great example.
Awesome. Well, we have a couple questions from the audience, and I'd love to ask you guys. And so Gary asks, really, what should a fintech look for in a partner bank? Kind of what are the key things that they need to look for?
So from my opinion, I think it's really finding a bank who is able and willing to be a good partner. I've seen if it starts off poorly, the due diligence goes poorly, the pitch goes poorly. The question is, do you want to work with these people if you have a successful program for years to come? So it's really, the relationship you can develop early on is equally important to the rest of what I'm going to say, which is, do they have the staff and the ability to manage the things that they need to? Do they have experience in doing it? And sometimes experience isn't bad, depending on the complexity of the product. But the more complex the product, the more you hope that they've seen it before. Otherwise, you're just battling every time you have a call, trying to explain to them that what you're doing is okay and why. So, and then I think the technology piece. Do they have the ability to manage the work that you're going to be sending to them in a way that uses, and are they familiar with all the technology that's going to be connected to this? Again, having to explain what Sardine is every time, having to explain what an API is every time, will not produce a successful program.
Yeah, those are really great points, Rick. And given the current environment where we're in, if we look at 2023, there was an inordinate amount of enforcement actions against past banks relative to the overall banking population. And I think, I go back to that old military adage, two is one and one is none. If you only have one banking partner, it's time to look at diversifying that risk and at least getting a second one on board, because I think many of the best banks have received enforcement actions or are under consent order, and that's not the end of the world. But I think it behooves all fintech companies to diversify the risk and have a backup in place, or I wouldn't even call it backup, just a secondary. And so if one does go down, then at least you have the other to rely on.
Yeah, I work with a number of lending clients who have just decided to go get state licenses rather than take the risk of working with a partner bank, just because it's unpredictable.
Yeah, and you see the people moving away from FBOs to getting their own MTLs, and
Mhm.
some like that's almost a piece of maturity. You can bring more of that in-house, but at the same time, there's still a need for a bank partner somewhere in some part of your stack, even if it's just sort of managing your own capital or your operating accounts and whatever else. So I think Rick's advice about sort of being a great partner, we're coming up to Valentine's Day. Sardine's going to be running a webinar on great partnerships because we need it right now. Like there's not a lot of love in that space, but some of the banks that have received consent orders, some of the ones that haven't and have done their job well. The one thing all of the banks that have done well in banking as a service and embedded finance have consistently is that they've been great partners and they've held the hand of the fintech company. They've been approachable. They've tried to make life easier as much as possible, within the fact that there are things they can't make easier and there are things that the fintech company has to do. But that is the nature of partnership, is to reach further than is necessarily required as part of your initial sale, and then catching some of the bugs that come along the way. Like, your implementation plan probably needs to think through all the things that might go wrong in your operational processes, like getting the reps in to have that level of maturity.
Yeah, it's funny when I think about getting into the fintech space now. It's been almost 10 years explicitly in fintech for me, and the word disrupt has changed, and the use of disruption has changed so much since then. It started out that everybody wanted to disrupt banking. We're going to disrupt the banking world. Well, by disrupting it, what you did was you took a section of one of the products that one of the big banks had, and you pulled it out and said, this is what we're going to do. We're going to do debit cards. We're going to do payments. We're going to do credit cards. We're going to do small lending, small loans. We're going to do mortgages, whatever. We're going to do the brokerage stuff. So you took your little piece and you developed probably a good program, a good product around it, and you've built this business. And then you start thinking, well, now we've got all these customers. We should think about adding additional products for them. And so I have the deposit side, but let's add credit, let's add brokerage, let's see if we can get into some of these other things. And all along, you never really disrupted banking because you were partnering with them for every part of your product offering. They hold the deposits. They're the sponsor of the credit program. They're maybe even holding your loans on their balance sheet. So it's moved from disruption to partnership. And I think that's the only way that you can be successful, is having that good partner.
I think though that is a uniquely US phenomenon. Speaking as the token non-US resident, in the United Kingdom, our digital banks have millions of customers and have de novo charters. Nubank has a de novo charter, and I think the lack of new de novo charters and/or some sort of equivalent, there are things that are now getting so big they would be coming up into GSIB categories on the B2B fintech side, right? Like, these things have tens of billions in deposits. Outside the US, they would be within Basel III. So that's kind of crazy to me that we're not considering crossing that bridge and we're pushing this systemic risk down. I think that's going to be a real pinch point, and I wonder how much pressure, post the next election, various sides of the house start to think about that.
Well, I wonder too how much is from the lobbying done by banks, right? That we don't want you to do that because right now you do rely on us. You rely on us for the SWIFT network. You rely on us to hold the deposits and be insured for those. So if I were them, I wouldn't want to let that go too easily either.
Well, I mean, and they have in fact been pushing hard against, special purpose, fintech banks and other, special laws for special products and other things like that.
Yeah, well, the Durbin Amendment didn't go well, right? They're not happy about that from the beginning when a lot of these started.
Yeah, Rick, I want to go back very briefly to one thing you were saying. Like, I always judge a partner bank by the quality of their due diligence on my client. If they're not doing a good job on my client, they're not doing a good job on anybody else's, and there's a consent order in their future.
Yeah. Yeah, no, I think that's absolutely right. I worry about those things too. When you see it, it's like, well, if ever the question of a program that I'm talking to was which bank is easiest to get through their due diligence, I said it's probably not one you want to use.
Right.
There's an inverse correlation there between the longevity. I'd be interested in a Rick and Jonathan benchmark of like who had the hardest due diligence. It is odd, isn't it, that like friction is actually a really good thing if done right. But it's the due diligence was challenging, but they helped us with it. Like, that's the tension.
Yeah,
they really tried to make it easy, even though it was challenging.
Right. And one of the things I've seen, I don't know how many times of the programs being concerned about getting something wrong in their answer back as part of the due diligence. Like, how do you do this? Well, the answer is you don't do anything yet. You're just starting this. You're starting a relationship with the bank. The expectation isn't that you've figured everything out yet. you need to have a good idea of how you're going to do it. But that's where that partnership thing comes in, is that if you have the right bank partner, they should say, okay, I see this part is incomplete. What are you thinking about doing here? And the answer back can oftentimes be, well, how would you like this to look? Let's work on it together. Let's get our BSA officer and your BSA officer together and talk about how we're going to build the parameters for transaction monitoring. What do you want to see? Here's what we want to see, versus, gosh, if I turn this in and you don't like my answer, are you just going to say no to sponsoring our program because I didn't know every answer to how I'm going to build out the parameters for our transaction monitoring before we have one customer on the books?
Not an SAT exam. It's like
Yeah,
not setting
right.
up your future.
Right, right.
It works out well for the lawyers because then they get to write a very expensive opinion letter saying no for
Well,
the
we're
bank.
trying to keep you in business.
Yeah.
Lawyers and consultants, who'd have them, eh?
Gosh, and Rick, I think you raised really great points around looking at the diligence of these fast banks. And to elaborate a little bit more on it for the fintechs out there, you know, all it takes is one bad apple, and then a consent order or enforcement action comes, and all the other fintechs related with those product types get raked over the coals. It means more administrative work for your teams in terms of supplying data, supplying information for testing purposes and so forth, or explaining this, explaining that. So it's really, really important. And I think there's a tension there, though, right? For those that are commercially minded, they would love to work with banks. You know, I once asked a Bass bank, what does your compliance program look like? And they replied back, well, what do you want it to look like? And you know, for the commercially minded, and you know, that's a dream. You know, they can do whatever they want. For compliance, it's okay. Well, who else is getting through the door at this bank, and what are the implications down the road? And
Well,
how
who
does
else is getting through the door, and do they have somebody like Gene helping them? You know, if so, then you're fine. If not, then you worry.
Thanks for the shout out, Rick. Yeah, exactly.
You're welcome.
Awesome. Awesome. Well, we are coming to a close for Fridays in Fintechs. You all have been wonderful, wonderful guests. Really enjoyed the conversations. And what we also like to do on this show is, you know, I love fintech, and what's a cool part of fintech? Closed loop systems, gift cards. So, you guys, since we're here, we're family, we'll get a small little gift card to Olive Garden. I think it's hilarious. But Simon, I don't know if there's Olive Gardens over in the UK.
I think you can buy the dressing at the grocery store. We'll send you some.
Yeah, I was gonna say,
we'll ship you. Yeah,
international
we may.
shipping is probably going to be like the entire $50, but that's cool.
Yeah.
There's this website you can cash it in, so it's fine.
Oh yeah, I'm sure that's legit.
They were not one of my programs.
That's funny. That's funny. Well, awesome. Well, really great having everyone on. You have a wonderful weekend, and look forward to staying in touch.
All right.
Thank you very much.
Thanks
Thanks,
so much,
everyone.
Jake.
See you guys.
Thanks, everyone.
Bye.
Bye.